So I guess to get started, it might make sense to introduce ourselves. I think everyone here probably knows who you are, maybe a little bit more confused about who I am, but I figure we can fix that really quickly. I'll tell you maybe just a little bit about Lumia Capital, and then Anderson can talk a bit more about Redpoint eVentures, and then maybe we dive into it. Does that work for you?
Sounds great.
Awesome. So Lumia is a Silicon Valley-based growth stage venture fund. What does that actually mean? Means that we tend to invest in companies at sort of Series B, C, D, all technology. And we really came into the market to address what we saw as two major needs. One of those is the fact that we saw in emerging markets that there was a notable funding gap that happens after the Redpoint eVentures of the world are able to invest. This is sort of at the growth stage. And we saw an opportunity to come in and try to fill what we perceived as a gap. We also saw that there was one type of value add that was very, very well covered by a few funds here in Brazil and in similar markets, again, like Redpoint eVentures, which is really, really fantastic local experts, right, who can add unbelievable local value, local connections, and local market knowledge. What Lumia wanted to do was to be complementary to funds like that. So coming in at the growth stage, when these businesses really have their sort of local focus, really have their product market fit, everything's well thought out, we come in to try to really make them a world-class business. And by that, what I mean is connecting them to the Valley. So that's technology, that's platform partners, that's mentorship, and that's, we hope, eventually exits as well. So that's Lumia in a nutshell. We're a growth stage fund. We invest in North America, Latin America, and EMEA. And I'll hand it over to you.
Thank you very much, Zach. Made my work a lot easier. Perfect. Thank you for the kind words as well. Good afternoon, everyone. My name is Anderson Thies. I'm a co-founder of Redpoint eVentures, which is an early stage venture firm in Brazil. As Zach mentioned, we are a local fund with a very strong connection to the Valley. That's where our name comes from. So it's a partnership between Brazilian individuals and two funds from Silicon Valley with global presence. We started in Brazil in 2012. We raised $130 million to invest in basically Series A and Series Bs in Brazil. There is a little bit of a translation problem here when we say Series B in Brazil. We are talking about up to $10 million, not the $50, $20 million that you see these days in the Valley. So our goal is to be the first institutional investor in the companies we back. And our goal is to back companies that will become really, really big. And in the process of doing that, our work is to help the company start well and then make introductions to partners like Lumia Capital that will do something that is still somehow new in Brazil, but is very important, which is the staged finance. So you start with a Series seed or angel round, then a fund like ours would invest, and then we help the company grow through different rounds of financing, participating in follow-on rounds, and trying our best to give comfort to investors like Lumia to come to Brazil and get exposure to the assets here and fill the gap, as Zach mentioned, and help the company grow going forward. As I mentioned, we are investing for the last 3 years in Brazil. We have 12 companies in our main portfolio, which is the Series A, Series B portfolio, where we are active investors and we take board seats. We also have a seed program in which we co-invest with other seed partners, and we have more of a passive role. We have other 13 companies in that program as well. So that's what we've been doing and what we are all about at Redpoint.
And Anderson, something we were talking about backstage a bit was, the concept of the importance of the exit itself, right? I mean, I think something that's come up a few times is there any other way that we can sort of make money as a VC without actually selling the company?
Yeah, that's part of the briefing we had to cover here. I think the short answer is, if there is another way for us to make money, we have a big problem with our investors. So in essence, that's our role, right? We manage capital from third parties. We collect that money, we fundraise just like entrepreneurs do. We put together a fund, and then we invest. Then we have to divest and return capital so that we can keep investing. We only can keep investing if we do that with a decent return, but that's the core of the business, right? So it's part of the game, and it has to be part of the agreement from the beginning.
What about secondary sales?
Yeah, this is a interesting topic. I don't know how you've been doing that at Lumia, but conceptually, exit for a fund like ours is when we sell our participation in the company. It could be a final exit also for the entrepreneur. This is what we want to see. That's what we would like to see when we invest in the entrepreneur. We would like to do the full journey with them. That's the ideal scenario. But it could happen as a secondary at a much later stage to a private equity fund, which has been fairly common in Brazil in the past, or in a, not as common here, but an IPO eventually could be an alternative as well. Mm-hmm. And we could sell and entrepreneurs could stay longer in the business.
Yeah, I mean, I think one thing that's been, it's a slightly controversial subject in the Valley. I think it's a bit of a newer subject, in Brazil. Secondary sales are something that I think have been occurring more and more often. And by that, for those who are not familiar, what I'm referring to specifically is the opportunity to sell your shares even before the company goes public, even before you have the opportunity to sell. So really exiting before the entrepreneur is. And there's actually a very developed market for this in the US. A lot of institutions, a lot of other investors approach us, to acquire our shares in certain companies that are more well-known in the Valley. And it's a bit strange because there's sort of a bad connotation to secondary sales, and part of it, I think, is warranted, right? There's a fear. It says, okay, these people, they might sit on the board, they're on the inside, they speak to the management, and they want to exit the company. So why should I be coming in when they're running for the door? But I think on the flip side, we've never done a secondary sale, and we would never do it without the entrepreneur supporting that decision. But there is a logic to it, right? If you've made 10 times your money in an investment, 20 times your money, whatever it might be, and maybe you can take a small piece off the table to return the initial capital or whatever it is, but it's a very controversial subject, and we've never done it yet.
Yeah, we haven't either. I think it's becoming more and more common, also because of something else the investors took over here was the maturity of an investment, how long it takes from investment to our exit, and the fact that it's getting longer and longer. IPOs are becoming, not long ago was 7 years into the making of a company. Now it's getting to 11, 12 years for the fast-growing companies. So I think for the investors, it will become more and more of a need or an opportunity as the market matures. It's already in the Valley, as you mentioned. It will eventually become in Brazil as well. I think also controversial and a stronger signal is the opposite, right? When entrepreneurs are doing partial secondaries in early rounds as well, which also has a big array of signaling attached to it.
Yeah.
But I think we'll have to learn how to deal with these things as companies tend to take longer from beginning to exit. So
I saw a term sheet not that long ago for a pre-revenue company in the Valley where the investor was going to let the entrepreneur take $1 million off the table, very small company, take $1 million off the table and then issue himself another $1 million of shares. So basically they were going to pay him $1 million to let them do the deal. So that's the kind of stuff I guess you don't see here just yet, but
yeah, no, absolutely not. And I think, as I said, one way to look at it is for an entrepreneur in a very early stage, what we as investors would love them to be thinking is that, well, this could be $1 million going into the business, helping this grow faster and build a lot more value for everyone, entrepreneur included, compared to, cashing out and early on and charging a toll for entrepreneurs, for investors to join in. But we'll see. Depending on how the market evolves here, we might see that happening. It's not something we are hoping for.
How do you feel about letting them take a little bit of money off the table, as the company progresses?
Depends on the stage and how long the entrepreneur has been, in the business. I think if it's something reasonable, we are not necessarily opposed to it. I think depending on how you structure the round and the stage and how long they have been running with the company, I think you can build a sound case for a partial exit in between. Mm-hmm. But in a very early stage, as a handsome to to join the company, I think it's poor signaling.
Mm-hmm. But, and I think one thing that entrepreneurs are always curious about is, when we actually do a deal, right? How are we thinking about what our target return is? How are we thinking about the exit, on day one, right? I mean, clearly, we want to help the entrepreneur build a big business, but at the same time, our LPs, expect a return on their capital. So how do you think about, the timing and the magnitude
for us,
method of a return, as you're engaging in your initial investment?
For us, I think it's a concern for every single investor. I think for investors in Brazil, it's a bigger deal, given the lack of liquidity in the market here. So what we usually do is part of our process before making the decision of an investment. We do think about exit alternatives. We do have a very open discussion with the entrepreneurs we back about it. There are a lot of people that make a parallel that investing in a company is like a marriage. And the biggest difference is that the divorce is planned and announced from the beginning.
You can't sell your spouse.
Yeah, that's a good point. But I think the most important process is that entrepreneurs that you're going to invest with or invest in, they have to understand your business model and participate in the construction of the road so that it's something that fits the strategy of the company and fits the personal strategy for the entrepreneurs. So it has to be discussed openly in the beginning and planned. Timing, I think it's a lot harder. I think when we are going to exit, there is way too many variables to discuss that when we invest as early stage, as Series A investors. But the fact that there will be an exit for us in the time frame of our fund, I think it's critical, and it has to be well discussed with the entrepreneurs. How do you go about that, especially spanning through different geographies?
Well, first I'll give an interesting statistic that we were talking about internally the other day. There's a fund of funds, so in other words, a fund that invests in VC funds, and it's called Horsley Bridge, and they tweeted the other day, we've never gotten really our target return on a VC fund that has not had at least 125x return company. So, when you're a VC and you're coming in, you do have expectations that there will be significant upside, and it depends a lot on stage. So realistically, we're a growth investor. We typically target 3 to 5x, but folks who are a little bit earlier, I would imagine you're looking more at that sort of Horsley Bridge number, which is the outsized fund returning investment.
Starting today, we are looking at 25x.
25x. I'll send you the tweet so you know I'm not crazy. But for us, I think this sort of feeds into aligning expectations around valuation when you come into a deal. I think the instinct as an entrepreneur very often is, you have a very strong sense of you're building something very valuable, right? And you want to take the term sheet that reflects the fullest value of your own business. At the same time, you can create serious misalignments with your VCs, right? Because, oftentimes the VCs are targeting, many multiples of their entry price as their target return. And you might say, hey, the price that the VC paid, if somebody offered me twice that, I would sell. But then you've gotten into a situation where you've got people on board, who want a multiple of that. So I think if there's a takeaway, tell me if you agree with this, but if there's a takeaway, when you take a term sheet from VCs, not only should you think about how you're positioning for the next round in terms of, being able to show continued momentum and markups, but you should think about the exits, and you should think about what the VC really needs from that exit perspective so that you can keep your incentives very aligned. Because the last thing, and I'm lucky to say we haven't run into this yet, the last thing you want to see is either a VC pressing you to sell before you're ready, which happens all the time, and we haven't been in that situation yet, or the opposite, which is you're ready to sell, and the VC wants to keep things going, and that could be an uncomfortable situation. I mean, have you ever run into that?
Yeah, it's a recurring topic here. There is even, in my opinion, a false perception that not only Brazilians but Latin American entrepreneurs tend to do that. I don't subscribe to it. I think so the thesis is, and we hear that from LPs as well, are Brazilian or Latin American entrepreneurs risk averse and they sell the company at 50 million when they can? I don't buy that. I think risk averse Brazil entrepreneurs just don't fit in the same sentence anywhere. So I completely disagree. I think what we had in the past is that entrepreneurs in Brazil didn't have access to capital. Guys like you were not visiting, and the next stage even less. So when they would reach the stage of a company that was worth $50 million, they would need to raise, let's say, $50 million to aim for $1 billion, and the capital was not available. Mm-hmm. So that basically two choices, either to sell or to sit on an organic business. And half of them would do one thing, the other half would do the other one. I think this is a misconception or misperception in the market in Brazil. But it happens a lot in conversations. I think the case in which entrepreneurs do not want to sell and VCs want to sell is more natural. Could be because the cycle of the fund is approaching the end, or enough. Even if we are halfway through our fund, we are 20x in the investment we've made, and we want to 25x, and we want to realize something like that. I think this is a natural conflict, and it has to be managed, and it has to be openly discussed. Find an alternative, do the second option for the VC in a way that the entrepreneur can continue, do a partial exit for the entrepreneur. There are lots of ways to address it. It's a conflict, but it's a natural one. I think the case in which the entrepreneur wants to sell too early, the way we would look at it is that we've made a mistake in the selection process. So, it's unlikely that we would force an entrepreneur to keep going. It's their company in the end. We are here to help as long as we are not creating too much trouble. But if the entrepreneur decides to sell, we are not going to. We could advise, but we would not enforce it by contract. I think it's a recipe for disaster and a lot of finger pointing. Wendy would definitely would say we backed the wrong guy. That would be our take.
When it's sort of generally agreed that it's time to sell, I mean, do you think us VCs have a role in that process at all? I mean, is that something you think we should get our hands dirty with?
Definitely. I think it's in exit and fundraising. I think it's like advisory for someone buying a house. It's entrepreneur will, if they are very fast in execution, they will do that 3-4 times in their entrepreneur career if they build big companies. Mm-hmm. If it's small companies, it could happen faster. But and we go through that a lot more often than they would. So I think it's there is alignment of interest to a large extent, and we have access to a network that can be very, very helpful. Doing the exit itself and preparing for the exit. So I think it's an active role we should be playing. Would you agree? How do you guys do there?
Yeah, I mean, I feel like there's a balance, right? Where, as the VC, you might have access to certain potential buyers that the company is not necessarily in touch with in their normal course of business. I think what you don't want to be perceived as doing is going out there and trying to sell the company before the entrepreneur wants
Behind
that,
it from
right?
the back, yeah.
Exactly. So, that's something that would be, even if there's a misperception of that, you guys are entrepreneurs out here, I'm sure you would be pretty unhappy with a situation like that. Now, on the other hand, I think, there's a position where the VC can help to raise awareness of these companies, without necessarily pushing a sale, throughout the company's life, right? So when the time comes, the buyers are there. Because there's a saying, right, is that great companies are bought, not sold, right? And this is sort of a Silicon Valley thing where it's like, we say it's a sort of champagne problem to have, and that there's so many people out there interested in companies that, you don't have to shop them, but there is a signaling thing, right? If you're trying to sell the company, it says the insiders say that this thing is sort of run out of steam, the returns are not going to be that good, we're ready to get out, right? So you sort of have to create that mystique. We're not ready to sell. We'd really like to keep running, and we'd like to keep building a bigger business. And that requires the buyers to then come in and say, okay, we're going to offer you 3 times, 4 times, 5 times what the last round was done at in order to motivate you to sell. So that mystique and that balance, I think, is very important for the companies. In our own experience, too, you never really know, who the buyer is going to be. I mean, in some cases, in our experience, the buyer has come somewhat out of the blue. Parties that we were cognizant of hadn't transacted with significantly, that wanted to sort of grow their exposure to that space, came in, and made a play for the company. On the other hand, we sold a company to someone who was already a minority investor in the company. In fact, when we came in to invest, in the back of our mind, we were saying, well, they would fit in really well with these people's suite of products. They're already a minority investor. They didn't really need our help at that point. So I guess if there's anything to take away from sort of this speech, it's a nuanced role for the VC, and I think experienced VCs know that you don't want to be creating issues with perception, but at the same time, there's a lot you can do to raise awareness. And frankly, sometimes there is a time where you sit down and you say, it's time where we need to look for our exit, either because growth is slowing down, because something went wrong, whatever it is. And when that situation happens, I think experienced VCs who have been through a lot of exits can help coach the entrepreneur, can help the entrepreneur find the exit, can help connect them to a banker who can sell them or a buyer who can buy them. And I think, being able to tap that sort of experience is, it's really invaluable, I think, for especially first-time entrepreneurs.
Yeah, I agree. You mentioned a few situations that would be conducive to sale that, stable growth or reduction in growth and so on. There are more opportunistic reasons to consider that as well. And again, it has to be a very open discussion with the founder, because no VC will be able to sell the company as well as the founder or the management team. I think it could happen in different scenarios as well. There is a consolidation in the market, and the company, in case, is in a very special condition. As you mentioned, the way the exit happens or the sale of the asset ends up happening, if you have a handful of buyers, you could be in paradise, right? Actually, if you have only 2 buyers that are really hungry for the deal, you end up with a premium, or you could be with a very interesting premium. And if you miss that wave, you could become the incumbent that will be disrupted by the next guy. So I think being alert is part of the game. The VC can play that role. We have access to a lot of intelligence in the market, but I could not agree more. It's the entrepreneur has to be the showman of the sales process as well, for a ton of reasons. It's the right thing, blah, blah, blah. It's also the best way to sell the company, the way to capture more value for everyone involved. So it's not only right, it would be silly to try different ways, unless there is a big issue or something. But in absence of that, I think it's smart to do the right thing in this case as well.
It's funny, we were told backstage that we should clash a little bit to make it more entertaining. I tend to agree with everything you're saying. You also have, a decade or two more experience than me, so I'm having trouble clashing.
Yeah, no, I think it's not a surprise. I think the way we think and we operate, we are trying to bring to Brazil, the learnings from Silicon Valley. I think this is the value proposition of what we are trying to build here, exactly what you described you do. So I think it's the biggest gap is not how we think about it. It's actually implementing it in the market, and I think we have to stick to the basics here until the market evolves and we see a lot of entrepreneurs operating the way the market works well and best for them. So it's I think the distance is not the way between the way we think, it's the way the market will mature. But I think we are in a very, very good route. And if we think about the ecosystem in Brazil, how much it has evolved in the last, 15 years, it's a lot. Mm-hmm. So just the fact that we are here with an audience of this size, it's a big indication. The fact that, there is a Brazilian association of startups of this size and putting together events of this magnitude, it's a very good indication. So very excited. We'll see.
And quickly, I think something that I'm sure a lot of people are curious about is, your perception towards the difference in the exit environment for a company that's maybe focused on the Brazilian market versus one that's more focused on sort of addressing the global market. Maybe we can clash on this one.
Yeah, so go first and I'll take the opposite view.
Okay. For us, I think it's a nuanced question, right? Because going after the global market and starting in Brazil is tricky. A lot of international buyers, I think, will be skeptical about the product market fit outside of the country. I think the nice thing about going international is what you can potentially do, easier said than done, is to move your management team to the Valley, which we don't have a strong view on that, if it's better or worse. What's nice about it, though, is it helps you attract capital and it helps you be more high profile for potential buyers. It's just sort of a psychological thing for people. I think, look, realistically, we like to say that there are sort of two types of companies in these markets. There's Skype, which was largely started in Estonia and is a global product from day one, because what can you do in Estonia? And there's Mercado Libre, right, which is a Latin American product from day one. It's regional, not country, but we like to say there's a lot more of the Mercado Libres. So sure, everybody would probably like to build a Skype and have a giant sort of outcome that's really global. But sometimes it's about what is realistic in the first couple waves of innovation in a market. And that's more of the Mercado Libre type businesses, the ones that know how to better serve the local market. Now, from an exit perspective, those have a big question mark, right? There's a lot of people we always talk internally, I'm sure you guys do too, that are logical buyers for a business like that, but it hasn't played out yet. So the global ones have a certain barrier to establishing themselves, but in the long run, in theory, it could be easier to sell, but it's a question of, it's not just very hard to build a business like that, realistically.
Yeah, I will try my best to clash. I agree, but I will agree for different reasons. At least we get close to it. It's part of it is our strategy and the way we are shaped. So we are a local fund to invest in businesses in Brazil, but a strong part of it is belief as well. A simple way to explain how we see the market, we believe the US is very easy to start, gets hyper competitive very fast. We believe Brazil is the exact opposite. It's horrible to start. There's a lot of bureaucracy. We joke it's high-hanging fruits, very sweet, but they are up high. But once you get to leadership in a market, you tend to have a lot more freedom to grow and establish yourself than in the US. Part of it is because it's a somehow captive market. Part of it is because there is a heck of a lot of things to be built. And if you are an entrepreneur thinking about building something, it would be silly to go after something that is being dominated by a good player, while so many things can be built, blue ocean style.
I agree, by the way. I'm sorry.
So we subscribe a lot more to the strategy of build in Brazil, win big in Brazil, become the leader, then win Latin America, build a strong foothold there, and then if you have built something that gives you a big mass and a lot of competitive advantages, then go venture globally. I think we don't have 300 examples of that in Brazil yet, but there are good examples of that. I think TOTUS is doing a good job in that way, closer to my heart and more proud of. I think Movili is doing a fantastic job doing that as well. When we first built the company, it was 2 small companies in Brazil. Now it's leader in Latin America, growing global. So I think we're more on that end, and I think we are over time.
We have time for 2 questions.
Hello, my name is Vera. I'm the founder of Incast. I have a question in terms of investing into marketplace. I feel like the VCs and private equities are away from marketplaces, but we see a lot of cases of success in the US as Elance, Odesk, they're merging to be Upwork. So can you explain a little bit what's the excitation in terms of marketplaces?
We have known, we love it. I think it's, in a way, we really like the model. It's not easy. It's 2 startups in one in a way. If we have investments that are 3-sided marketplaces, and then you have 3 challenges, at once. So it's hard to balance. But you have to build, assuming it's a 2-sided marketplace, you have to build both sides. There is usually a good way to, finance a catalyst to one of them. But we have nothing against it. We love it, both here and in the US.
I'm going to give. Wait, am I off? Oh no, I'm still on. I'm going to give a super gringo perspective on this, so you'll have to forgive me. But marketplaces are great businesses, right? They're sticky. They're typically very high margin. In theory, it's a great business. What's about a marketplace, and you touched on this a little bit, is that it takes a while. It takes a lot of patience and a lot of effort and a lot of execution to build scale. The typical growth stage fund like ours, we look at marketplace businesses and we love them, but what we often say is that it's not late stage enough for us. There's not enough traction. And part of it is with good reason. I am never going to understand the Brazilian market as well as a Brazilian. There will always be informational asymmetry. So in theory, I actually love marketplace models, but I will sit on the sidelines for a little while and wait for it to be proven, wait for there to be a very clear product market fit on both sides and liquidity in the marketplace and traction before I feel comfortable jumping in as a gringo who loves the Brazilian market, but admittedly just doesn't know it as well as someone who is born and raised here. Am I making that noise?
Hi, I'm Bruno from K2 Group. My question is about seed investments. If you reserve part of your portfolio to invest or to co-invest with others into something that gives you large deal flow in Brazil. If you do something like that and how it works. Thank you.
I mean, for us, it's tough, right? We like to say that sitting in Silicon Valley, we can't be in, every meetup in places like São Paulo and Rio and Curitiba and so on, right? So we're at a major disadvantage investing in the seed stage. We'd love to, right? I mean, the returns are huge if you invest in the right companies there. But for us, we're actually, unfortunately, very dependent a lot of the time on folks like Redpoint eVentures and some of the other investors in the market to identify the companies, whether it's at seed A, even B, and to help us then really filter down the universe of companies and select, because realistically, I just don't think we can cover the seed stage from afar, and I don't think it's very effective or efficient for us. And believe me, it pains me to say that because it's the most exciting stage, right? But you know, we have limitations.
Yeah, we do have a seed program. We actually created it after the fund was raised. So it's not our core, it's not something that we are good at. So we don't do that as a core strategy. If we try to do both, we would probably suck at both. So it's the pato, the duck metaphor. So what we decided to do is our core is Series A. That's what we do. That's what we believe we are good at. We are active investors after we do the Series A investment. Doesn't have to do too much with the size of the round. It's more, are we active? Are we taking a board role? Are we talking weekly with the entrepreneur? Is the opportunity clear enough for us to make the move and invest? Has nothing to do with traction. It's not hedging. The reason why we created the seed program, I agree, is very sexy, very exciting. But the reason why we created this early in 2012, when we started investing, happened often to us. An entrepreneur would come with a very exciting idea. We would say, look, I cannot write you $2 million check now. Go, raise a seed round, run a little bit, and let's talk again. And in 6 months, we would get an email from the guy, oh, I'm now working for Facebook. And I was like, what happened? And there was a myth, which I think it's being dismissed now in Brazil, but there was a myth that venture capitalists in Brazil would only back companies that are copycats or that have a role model in the US or whatever. I have absolutely nothing against it. I think copycat is an unfair term. To do anything in another geography, let alone Brazil, it's reinventing it anyways. But one thing, if you start a copycat here, is that one thing you know for sure, you have a very good competitor, right? You would not copy someone that is, not great at it. So, and we like the best business model is monopoly, right? In whatever industry. So having something disruptive, we would love to have it. And interesting opportunities in Brazil were not getting funded because of this myth that angels and some seed funds had that, oh, if there isn't a US company doing that, I'm not going to get a VC to even look at the company. So it was we are passive investor. We have a rule. We have 2 meetings to make the decision, and we have to say 5 times to the entrepreneur, it's just money. Because otherwise we don't do our job correct. So we are passive investor. We end up doing a little bit more than we should, but that's the thesis. And the only thing we want to do is to say, look, here is a check, $100,000 from a VC. If this thing works, at least one VC is going to look at it, right? We are not going to trash our check. So it was more of a signaling tool to do precisely what you said. It's to try to be a catalyst and generate a exciting deal flow of truly innovative companies in Brazil. Has been working really well. We didn't have expectations of making money. We did an exit, so we might not end up making money. But actually, it's already profitable on paper, at least. So it's a small, we have 13 companies. Seed stage, some people argue portfolio size should be 50, others argue it should be 100. We are not aiming for that, but it's working. And the experience has been fantastic. But yeah.
Zach Finkelstein and Anderson T, senhoras e senhores. Palmas para os dois.
Thank you, everyone.
Thank you very much. Obrigado, Anderson.